An exchange-traded fund, or ETF, is an investment fund that trades like a stock. ETFs, like other funds, pool together money from investors into a basket of different investments, including stocks, bonds, and other securities. By spreading the fund's money into different securities, ETFs can generally provide investors with diversification, which can help balance risk. And because ETF shares are traded on a stock exchange, they're simple to buy and sell. Just like there are a variety of mutual funds, there are a variety of different ETFs, each with different objectives. Some ETFs invest in a variety of stocks and bonds. Some replicate the performance of a stock index, like the Dow Jones Industrial Average or S&P 500. And others track the performance of a particular market sector, like technology or pharmaceuticals. But with these ETFs that focus more on specific sectors, the benefit of diversification diminishes. Let's look at an example of investing in an ETF. Suppose an investor wants to make a diversified investment that is designed to mirror the performance of a major stock index, like the S&P 500. After researching different funds and finding the one he wants based on his objective, he purchases shares of it through his broker, just like he would an individual stock. Now that he owns shares, the investor has a stake in each of the fund's basket of investments, while only having to purchase one fund. Participating in the wide market with only a single purchase instead of multiple purchases saves our investor research and analysis time. So how can an investor potentially achieve a return from the ETF? Like stock, he can earn a return two ways: a rising ETF market price and dividends. Typically, if the value of the fund's investments increases, so does its price. If our investor purchased a hypothetical ETF at $40, and a year later it was selling for $50, our investor may profit $10 per share. Of course, if the ETF would have dropped in value, our investor would have lost money. Because many ETFs are traded on a stock exchange, they can be bought and sold throughout the day. However, not all ETFs are widely traded and can cause problems when trying to fill orders. Now, compare this to a mutual fund. Most mutual funds are only priced and traded at the end of the day and aren't as easily bought or sold. Separate from changes in price, our investor may potentially gain income if the ETF pays its investors a dividend, which is a payout of part of the fund's earnings and capital gains. Not all ETFs pay dividends. Many instead reinvest earnings into the fund's holdings. One of the ways to tell whether a fund pays dividends is to look at what's called its dividend yield. This yield is the amount that a fund pays out compared to the current market price of a share. ETFs have other potential advantages too. While most mutual funds require a minimum investment, which can be substantial, an ETF investor only needs enough to buy a single share plus any transaction costs. Also, because most ETFs aren't actively managed, they typically have lower management fees than mutual funds. There is a wide variety of ETFs that attempt to track assets like corporate bonds, stocks in remote countries, commodities, and even currencies, among many other investments. While these assets carry unique risks, the ETFs that track them offer investors a practical way to analyze and potentially find opportunities in a number of markets. Want to learn more about ETFs and other investments? Continue with your investment education with Premier Education, brought to you by Invest Tools from TD Ameritrade Holding Corp.